Have you ever seen someone trying to trap a bird between four walls, but the bird still flew away? That's your Iron Condor when the market breaks the range. Hello everyone, I am Pranav VK, your friendly navigator in the ups and downs of options trading. In this episode of Stockshaala by Kotak Securities, we are going to learn how to do adjustments for Iron Condors. Adjusting Iron Condors is something that every range-bound trader must master because the market never stays in your cage. Let's do a quick recap of what is an Iron Condor. The payoff diagram of an Iron Condor looks something like this, and it is a combination of a bull put spread as well as a bear call spread. And if the market stays between this range, then the trader is going to have maximum profit, whereas beyond these two ranges, he's going to start having losses. Now let's say these two ranges are 19,500 as well as 20,000. But what happens if the market starts trending beyond these two ranges? That is when we need to start adjusting the Iron Condor. So to avoid panic exit and to adjust it like a pro, I'm going to teach you 4 different adjustments. The first adjustment is shifting the breached side. So if it is breaching either on the upside or on the downside, we are going to shift on that specific side. The second adjustment is converting the Iron Condor into an Iron Butterfly. The third adjustment is adding a directional bias. And the fourth one is booking profits on the unbreached side. So let's understand the first adjustment. The first adjustment is shifting the breached side. So let's say, for example, the market starts breaching on the upside by 100 points. So in that case, what we are going to do is we are going to shift the put option leg by 100 points. Here, the key factor is that we are going to shift the positions proportionately. So in a bull put spread, we have the sell position. So let's say initially we had 19,500 PE, and if the market went from 20,000 to 20,100, in this situation we are going to book a profit on the 19,500 PE and shift it to 19,600 PE. This way the entire range is going to narrow down, but at the same time it is going to reduce your risk. Similarly, let's say if the market went from 19,500 to 19,400. So what you're going to do is on the bear call spread, let's say you had 20,000 as the call option, initial call option, then you're going to book the profit on this and shift it to 19,900 call option. So here there was a shift by 100 points. So I'm going to also reduce by 100 points. So again, we are doing it proportionately. Again, in this case, it is going to become narrower, but you're going to reduce your risk. Here's an important point. So along with the main positions, your buy positions, which are basically your hedges, must also be shifted proportionately. So the second adjustment is converting an Iron Condor into an Iron Butterfly. So in case the IV falls and the range contracts significantly, during these times, what you can do is you can shift this Iron Condor into an Iron Butterfly, and you can do this by simply exiting your positions on the PE side as well as the CE side and entering into a single strike of both CE as well as put option. This conversion or adjustment is ideal when you see a consolidation just after a breakout attempt. The third type of adjustment is called a directional bias, where you're converting your Iron Condor into a broken wing condor. So let's say for a bullish bias, we'll understand with an example. Here we have a pure Iron Condor where the put sell is 19,500 put option by receiving a premium of 60, and the put buy is 19,400 put option by paying a premium of rupees 40. Similarly here 19,700 as well as 19,800. So if we look at the net credit, then 60 and 60 is adding up and 40 and 40 is reducing. So the overall net credit for this strategy is rupees 40. So this is a very balanced Iron Condor with symmetry on either sides, and the profit is going to be maximum if the market stays anywhere between 19,500 as well as 19,700. Now to convert this balanced Iron Condor into a broken wing condor where we have a bullish bias, what we have to do is we have to widen the spread on the put side, which means the buy hedge, which is now at 40 rupees, can be widened and we can go further away so that this amount of money that we pay is going to be reduced. That way the net credit is going to increase. So this is going to help us collect more credit on the bullish side. So here in this case, we have 19,400 at 40 rupees premium. Instead, what I'm going to do is I'm going to go for 19,300 and pay just rupees 20 in this case. So my overall net credit here will increase by 20 rupees. So my overall profit is also higher since the market is going to be bullish. The resulting adjustment after the payoff is going to have a lot of benefits. The first one is that the break-even point of the Iron Condor is going to get lower, which means you have more cushion, and as well as on the upper side. So you have more cushion on either sides. The only drawback of this kind of an adjustment is that on the downside, the loss is going to increase slightly because here we have widened the spread. Now that we have done it on the bullish side, let's also understand how to do it on the bearish side. So if your view shifts from a range bound to a bearish market, so similarly how we shifted the put side, we widened the gap. Similarly, we can do it on the call side as well. So here, instead of 19,800, I can go for either 19,900 or even 20,000, sorry. And the premium will go down from 40 to 20 rupees or even 15 rupees. That way, our net credit, which was initially rupees 40, will again increase by 15 rupees or 20 rupees, and that is going to be our additional profit for doing this adjustment. By doing this adjustment on the bearish side, you're telling the market that the market might not really go bullish anymore, but rather it will stay range bound or will go bearish. So which means you are going to make more profit from the market. Now let's also look at the payoff diagram when we do these adjustments on either side. So if the original Iron Condor looks something like this, when we do the first adjustment where we are doing it on the bullish bias, so the loss on the downside would have been higher and on the upside would be smaller. So it's going to look something like this. So like we discussed, you're going to have a higher loss here compared to on the upside. But if we do it on the bearish bias, then it's going to be the opposite. Where the loss on the upper side is going to be much more compared to on the lower side. Now let's look at the fourth adjustment and the simplest one. It is basically booking profits on the unbreached side. So in the Iron Condor, you know that it's a combination of a bull put spread as well as a bear call spread. So if the market has moved higher, then what you can do is book the profit of the entire bull put spread. Or vice versa, if the market has been bearish, then you can book the profit on the entire bear call spread. So whatever profits you have booked, you can reuse those margins. Here are the key principles that you have to remember when you're doing adjustments on Iron Condors. The first one is don't sit idle. Small adjustments can prevent big losses. The second one is roll before the breach hits your stop loss levels. Use implied volatility as well as trend view to determine which adjustment to go for. And finally, track your risk to reward, especially after the adjustments. Here is a bonus tip. If you check the option OI shifts, then you'll know where the writers are shifting, and that is when you have to shift too. So let's summarize what we have learned so far. We understood that the Iron Condor is nothing but a combination of a bull put spread as well as a bear call spread, We also learned the 4 different types of adjustments. The first one is shifting the breached side. The second one is shifting the Iron Condor into an Iron Butterfly. The third one is a directional bias, either on the bullish side or as well as the bearish side. And finally, the fourth one is booking partial profits on the unbreached side. We also learned a few points where we have to remember while doing adjustments in Iron Condors. If you like this video, then go ahead and share it with your friends and subscribe to our channel. You're watching Stockshaala by Kotak Securities. I am Pranav VK, an NISM-certified trader and trainer, and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.